All right. So that's, of course, the Commerce Minister speaking about STT and how markets need to cool down in terms of a reaction. But let's switch focus. Neelkanth Mishra joining us, Chief Economist, Axis Bank and Head of Global Research at Axis Capital. Neelkanth, it's always great speaking with you, especially on a day like this, to contextualize everything that's happened with regard to the budget. First off, let me get your take with regard to the fiscal deficit, the targets, as well as the gross borrowing number, which to a certain extent did spook a certain cohort of analysts yesterday. Where do you sit with regard to a view on that?
So the budget in many ways was absolutely predictable. There was not much of a surprise, and I mean it in a very good way. I think the government increasing the visibility and reducing policy uncertainty for businesses and investors is a very positive step. The hard miles on fiscal consolidation are behind us. So, as you know, a reduction in fiscal deficit is a drag on growth. So clearly now with the deficit barely falling, the economy can start getting closer to its trend growth rates. But in order to close the output gap, we are maybe 1.5 years behind where we were supposed to be if COVID had not happened. This remarkable fiscal discipline needs to show up in lower bond yields, lower cost of borrowing. And unfortunately, as you also mentioned, the borrowing targets and the perhaps excessively conservative plan to finance it. See, what has happened over the past 2 years is that government cash balances have actually shot up. So what used to be 0.51 lakh crores, 0.51 trillion rupees overnight has now risen to maybe 3.5 trillion rupees, sometimes even 4 trillion rupees. And as the government cash balances go up, they actually go out of the deposits, so the bank out of the banking system. This uncertainty itself has, I think, has pushed up the cost of liquidity. So if the banks today are borrowing 12-month money at 7%, it is not surprising that they're actually selling their holdings of Government of India bonds to generate that liquidity, because those are yielding 6.6, 6.7. And not surprisingly, the surprise on the gross borrowing target has meant that the yields today are 6.76. So despite fiscal discipline, which is politically challenging and very hard to do, despite sticking to the debt consolidation, the path, the transmission to lower rates is not happening. And that, I think, is the biggest challenge that confronts RBI and the government, because unless you do that, how do you close the output gap? Significant injections of liquidity, I think a lot of signaling, the government's efforts to manage its cash balance more proactively. I think all of these are important measures to address this challenge.
Absolutely. So Neelkanth, you also have flagged off that without big disinvestment, further consolidation gets tough. Has India hit a fiscal ceiling in that sense?
Look, the fiscal deficits at the central level are almost back to pre-COVID levels. This is a remarkable achievement. So the 4.3% deficit includes about 0.55% of GDP of the interest-free loans to states for CapEx. So if you remove that and you compare it to where we were pre-COVID, they're almost there. And in fact, pre-COVID, we actually used to have many of these off-balance sheet issues, which I think have been now mostly addressed. So it's a much cleaner number, and on an adjusted basis, I think is far superior to the fiscal deficits that we used to work with earlier. The economic survey itself says that 6% of GDP at the general government level. So in FY27, based on our estimates of what states may report, we should be at about 6.6. So the hard miles on fiscal consolidation have been crossed. The fiscal deficit doesn't need to fall meaningfully from here. But remember that if your debt to GDP and if the government is reducing crowding out, it enables the private sector to grow faster. And this is a fiscal versus monetary choice that policymakers make. And I think very prudently, the government of India has chosen, policymakers have chosen to take the monetary route. And it is not surprising that the yield gap between, say, the US and India has started to narrow. So what used to be 8% in India and 2% in the US is now 6.5% in India and 4.25% in the US. And frankly, if the liquidity situation is managed well, my expectation is that we'll be closer to 6% in the next 12 months. And therefore, the yield gap narrows even further. This is the right choice, but I think we need to do some work to move in this direction.
I want to talk about CapEx also, Neelkanth, because, while it's growing broadly and it's in line with nominal GDP, but you say that quality has improved and you've marked that out. Tell me, where exactly is this quality upgrade in CapEx visible?
See, some of the, so you can see that, the money that was being put into BSNL, BharatNet, so those have been, I think, anyway, that expenditure is done. The efficacy of that and how quickly it revives BSNL's prospects, and really what was the plan that, for ARPUs to, telecom ARPUs to fall to 20-25 rupees, which is required for the next leg of telecom penetration. So some of those are let's see how the execution works. But what we are seeing now is, CapEx starting to happen on railways. I think there was a challenge with the national highways. I think the strategic plan was a bit of an issue. We are now, it looks like we are done with that, and now expenditure can start happening. Tendering for national highways can start to pick up. The expenditure improvement, quality improvement I was talking about is that if the government spending on the whole is rising at 7%, but CapEx is rising at 11-12%, it's actually it shows that the government is refraining from wasteful expenditure and focusing on what it must do instead of using taxpayer money and so on. So I think these are all philosophically the right things to do, and I'm very happy to see that in the budget.
Ajit here, morning. If you look at the target that government has set, 50% plus or minus 1% of debt to GDP ratio by 2031, it basically gives you an indication that by the time we reach FY 2031, the fiscal deficit target would be around 4% instead of the 3% what we were trying to target, and the amount of borrowing that additionally we have to do or can be done would be around 10 to 12 lakh crores. Isn't that a issue for the markets?
I don't think that's the right math. See, so we are at about 6.6% in FY27, the general government deficit, because finally, when you're thinking about crowding out, that's what matters. Especially if 0.5, 0.6% of GDP is the central loans to states for doing CapEx, and so from the perspective of the center or at a general government level, we are not too far. In fact, I would say that if the nominal GDP growth was to be in the 10 to 11% range, and we are able to get the rate transmission challenges sorted, perhaps meaningful consolidation from here is not necessary. And that 10 to 12 lakh crore gap, which of course may be someone's estimate of what the funding problem can be, may actually be a lot lower. Remember that EPFO, the penetration of pension funds, penetration of insurance, there's so much effort being made to deepen penetration of both of these, as well as at some point the bond index inclusion. If India's sovereign bonds on India's economy is the only large economy at least attempting fiscal consolidation, and I think we are the only ones who have kind of brought it back to pre-COVID levels, why wouldn't foreign investors want to participate in this? So if you're thinking 3 to 5 years, I'm quite sure that further fiscal consolidation may not be necessary, especially as a 4% that at a headline level would be equivalent to 3.4% adjusted for the interest-free loans on CapEx for CapEx to states. Therefore, at an aggregate level, there is not that much of an impact on additional borrowing.
Neelkanth, the golden question, and really it impacts the way FIs look at India. It's the rupee's moves, right? It's been a bit volatile and it's been weak. How are you viewing the moves? When do we stem the tide? And even on bond yields, you suggested that we've seen a bit of a spike. How do you kind of rationalize the difference between the bond yield and the repo? We've been continuously cutting the repo, and that benefit is being passed on to NBFCs. What's the impact there, if you can give us a sense?
So let me take the second part first, and then we'll discuss the rupee. So this is exactly what I was trying to address. That despite the reassurances that liquidity will be in surplus, what we've been seeing is that sporadically, but that's enough to add to risk premium. Meaning that if say a few days in a month, or say a couple of days in a week, you have liquidity tightening. It warrants that every participant in the market will then play it excessively safe on the liquidity side, and therefore having predictably sufficient liquidity, having a much more practical definition of what good liquidity is. A good liquidity situation is not just the weighted average call rate being in a narrow band. It is that a CDOI spread, which is effectively the certificates of deposit versus expectation of future repo rates. That spread, being at 175 basis points in the month of January, means that, in any other market, this would be seen as a heart attack in the financial system. So these are very, very high rates, and I totally agree with your observation that the repo rates are being cut, but the 10-year yields are not falling. Generally, when you are close to the rate cut end, yields do stop falling, but they stop falling from where the term premium, basically the gap between the repo rate and the 10-year yield is much narrower. It is maybe 60-70 basis points instead of the 150-160 basis points that we are talking about here. So that's the challenge, and I think that needs to be addressed. It's a combination of the government issuing the right duration of paper. I think there's some attempt to do that in this budget, as well as managing its own cash balances much better, because that volatility is a challenge. And then the RBI taking adequate measures with open market operations and other measures to make sure that liquidity is sufficient. On the currency side, I must say that the fundamental analysis on what really is India's balance of payment deficit does not show a big concern. I think the reason why there still seems to be this incessant demand for dollars is that a large number of participants had stopped hedging. So in the policy error that was made, I think, 2 years back, where an attempt was made to peg the USD INR at 83 to the dollar, had resulted in a number of importers just doing away with their hedges. So think about it this way: $750 billion of goods imports, $200 billion of services imports. Not everyone needs to go and hedge. Some people have dollar revenues as well. But if you just assume that 10% lower hedging is like a $95 billion reduction in dollar demand. So when our reserves went from $600 to $700 billion, it was without, again, any change in balance of payments. So in some ways, the pressure we are seeing is that people who had stopped hedging are going back and hedging now, and therefore adding to the demand for dollars. So there is significant amount of readjustment that I think has already happened. My guess is that the rupee from going forward has mild, not wild depreciation, and I don't really, because so long as the balance of payments on a flow basis is sacrosanct and is in control, I think there is nothing to panic about on the rupee's moves.
Substantial portion of the unwind on that has happened, Neelkanth. You believe that we're pretty much at the fag end of it, and therefore, I mean, you said that the impact on the rupee should be minuscule, right? You believe that a large part of the unwind has happened. I just want to try and take that as a conclusion.
To see the challenge in doing that analysis sitting outside the RBI is that the data on the split of merchant flows by spot and forward is available with a 2-month lag. So it's very hard to conclude on an important point like that. But for policymakers, it's going to be a lot easier because they have access to all the data on the live basis, and they will be better judges of that happening. But even looking at what had happened, say, 2 to 3 months back, it looks like, based on some extrapolation, that the worst phase of excessive demand for dollars over and above what's happening on the balance of payments seems to be behind us.
Okay, thank you so much, Neelkanth, for that. Of course, those are very interesting insights across the board. And thank you so much for coming in and giving us that perspective.